Hi there, welcome to Kneppy Invest. One of the personal benefits I get out of doing this channel is I actually do learn a lot about companies I otherwise would never have learned about. And that's definitely true for a company called Iress that'll be featuring in today's Kneppy's analysis. Now, I roughly knew what this company did, but as I delved deeper into the history of this company, I did take a few things out of it. Now, I have my own biases, and my natural bias against this company, I had to test it in this video. Was I being too harsh on this company? So I'll let you be the judge during the rest of this video. And when I actually go back through this company's history, I actually could have seen myself taking a position in this company back in, say, 2003, 2004, because this company had a lot going for it back then. But things aren't running smoothly for this company right now. And again, that will become obvious as we go through the rest of today's video. So even though I'm not that interested in this company right now, and there are a few ways I could become interested in Iress, and more than likely that's only for the short to medium term, that doesn't mean there's going to be other investors out there who have no interest in this company. And one of the main reasons I do this channel is to share ideas with you. So here is an idea, or possible idea, of a company that I'm not that interested in right now. And that company is Iress. Well, this is going to be fairly obvious. I've already sort of given it away that I have no holdings in Iress at this point in time. I actually have never owned Iress, and I can't see myself owning Iress in the near term. However, when we do look at the chart, the daily chart, there is one scenario I could see myself take position in, particularly if the company comes out with a profit upgrade. And in fact, that's probably the only way I would take a position in this company right now, is that profit upgrade. Good financial performance or improving financial performance from this company. So what exactly does Iress do? Well, I'd let the company speak for themselves. I went to one of their presentations and they had a few good slides. So we can get a little bit of history about the company, a very small amount of history from the company in this particular slide. Established in 1993, they provide essential technology to the Australian financial services industry through software, and listed on the ASX in 2000. And some of the things some of the areas they provide software for include financial advice. In fact, 37,584 Australian Xplan users. I'm assuming Xplan is their financial advice software. 120 million records processed daily. I'm not sure if that's impressive, but 120 million records processed daily does seem a lot. Trading and market data, that's another area they provide software for. And also superannuation. They provide software in that space. In fact, 27% of total super funds under management managed through Iress software. But times have been tough for this company. And in fact, the management of Iress would be the first to admit that. And one of the reasons they're the first to admit that is because Iress has a new CEO. I'll talk about that in a second. But this is straight from one of Iress's presentations. And this is looking at the revenue and balance sheet, profitability, and total return to shareholders since they listed on the ASX. And they divided the performance of the company into three different eras. Era 1 was the first 13 years on the ASX. Era 2 is the next 10 years. And Era 3 has been the last 5 years. And the performance of this company has been quite disappointing over the last 5 years. In fact, you could say the performance of this company has gone down since they listed on the ASX. So we look at total revenue. In the first era, revenue grew at 19% per year, down to 12% in Era 2, and then down to 7% in the last 5 years. And invested capital going from 65% down to 20%, down to 6%. Profitability, no plat, not sure what that is, from 20% to 8% to negative 6%. And total return to shareholders, 40% in that first era, that first 14 years, down to 10% between 2007 and 2017, and negative 2% in the last 5 years. So the last 5 years has been disappointing in regards to performance of Iress, and maybe that's why there is a new CEO in charge of this company. If you have been an investor in software companies, you might know the rule of 40. So that is adding up revenue growth plus EBITDA margin. And the rule of 40 just suggests that you want that number to be over 40. And unfortunately for Iress, it's actually well below 40, mostly because of the lack of revenue growth. So in this particular slide, again, straight from an Iress presentation, they are comparing themselves to companies like Xero, WiseTech, Technology One, Altium, NetWealth, Salesforce, and Atlassian. And if you do look at the performance of those particular companies, you could probably argue that WiseTech or maybe Atlassian are the best performing companies. I'll probably lean towards WiseTech. That has pretty good revenue growth plus really good EBIT margins. Atlassian has really good revenue growth, but the EBIT margins are a little bit lower than WiseTech. But the main thing is those other companies all have a rule of 46 or are successfully above that rule of 40, while Iress is actually well below that rule of 40, again, because of lack of revenue growth. Now, their EBIT margins is fairly similar to Xero, but they don't have the revenue growth that Xero is experiencing right now. So this is another sort of indication that management are not happy with Iress's performance, and another reason why, when I say management, I'm also talking about the board of directors, and also another reason why there is a new CEO in charge of this company. And that CEO is Market Price, CEO and Managing Director, joined Iress in 2022. So a lot of his initiatives, we don't know if they're going to be successful or not. I'm not even sure of what the new initiatives are in regards to Iress. They just know that the company has not been performing to expectations. So more than likely, there are going to be new initiatives brought in by Marcus Price. He does have an interesting history. He was a founding CEO of PEXA, Property Exchange Australia, and I do know a little bit about that company, and that is an impressive company, which he led for more than 9 years. And prior to that, he had senior positions with NAB, the Boston Consulting Group, Certain Group, and previously served as CEO and Executive Director of both Equifax and Dun & Bradstreet. Now onto the quality of Iress, and I think most of this has already been fairly obviously stated during the start of this video that I don't consider this company to be high quality right now. That could change in the future, and maybe about 15 years ago, I might have considered this company to be trending towards becoming a high quality company, but we don't have any indications that this is a high quality company. So the first thing I always look at is revenue growth. In the last 10 years, revenue has been growing at 7.2% per year. 5 years, 5.2%. Last 3 years, 3.8%. So we are seeing revenue actually decreasing in terms of growth. And that's the first thing that the new CEO needs to address is a return to revenue growth. Return on invested capital, 9.3. Typically, I want to see that above 10. And historically for this company, it has been above 10. But it is concerning the return on invested capital has been dropping. Even EBIT, 26.3. So even though I consider this to be a low quality company, or you might think that there isn't any premium attached to the value of this company right now, and it's complete opposite. I think this company has been or is overvalued, but that might be because profitability has been falling and the market hasn't quite adjusted to that drop in profitability in this company over the past few years, and total return over the past 10 years. So if you have been a shareholder of this company over the past 10 years, you have seen returns of only 5.9% per year. So that's share price appreciation and also dividends. That's not a really good return, per year return over the past over a 10-year period. So I do refer to this company as a low quality company. And the only reason I'd become interested in this company right now is any trading scenarios. So a trading scenario would be a nice uptrend in the share price on the back of some positive financial news. So I do these sort of things for every single company on the ASX, and I always leave a bit of notes just to see what I was thinking when I went through the company. And for Iress, I just mentioned low revenue growth and also decreasing return on invested capital from greater than 10 to below 10. And that's the main reason I consider this company to be low quality right now. Doesn't mean it can't get there in the future, but at the moment, low quality company. Now let's have a look at a few of the facts in regards to this company, listed on the ASX November 2000. So it's been around for about 22 and a half years on the ASX. Share price about $10.50. I think it closed at $10.80 on May the 22nd. Another thing I look for is shares on issue. Have they been decreasing, increasing significantly? So shares on issue have increased from 140 million to 187 million. So that's nothing too dramatic over a 10-year period. And the market cap of this company is just under $2 billion. Now let's have a look at the financial performance of this company. This is for financial year 22. Revenue of 618 million. And this company is global. We'll talk about that in a second. Profit of 52.7 million, operating cash flow 97.2, free cash flow 89.5, return on equity 11, so that's above 10, but I prefer return on invested capital, which is a little bit more conservative, also takes into account debt, that is 9.3. I do prefer that to be greater than 10. One of the things I like to see when I am researching a company is just how geographically diverse a company is. And I also like to see a revenue breakdown if they have different segments or divisions. So this particular note 1.3 within their financial statements addresses this breakdown. So we've got a breakdown of geographical region and also through their revenue streams. And they have, according to this, 4 revenue streams: software license revenue, implementation and consulting revenue, royalties revenue, and other auxiliary fees. But the majority of their revenue is software license revenue. And they've also broken down all those different segments into geographical area. So Australia, Pacific and Asia, UK and Europe, mortgages, South Africa and North America. I'm not sure of the geographical location of mortgages, but I'll have to learn where exactly mortgages is. And by far, the biggest geographical area is Australia Pacific, which is understandable, but they also have a fairly big presence in UK and Europe and a much smaller presence in South Africa and North America. In fact, in North America, almost negligible presence there with only $31.5 million of revenue in that geographic area. Now to one of the main problems with Iress over the past 10 years. So in this particular slide, we're looking at total revenue growth. I prefer revenue per share growth because that way you take into account any capital raisings the company has done or maybe any share buybacks. So I like to see revenue growing through time. And when you look at Iress, revenue has been growing through time. In fact, over the past 10 years, revenue has more than doubled from $251 million in 2013 to $618 million in 2022. But the big problem in regards to this company is margin pressure. And I've included gross margins and operating margins in this slide. And both of those margins have been decreasing and have decreased significantly over the past 10 years. So gross margins have fallen from 38% to 28%, while operating margins have fallen from around about 23% down to 17%. And this is one of the reasons why the financial performance of this company has been quite disappointing over the last 5 years. And that disappointing performance of Iress over the last 5 years can be seen in their dividend history. Between 2013 and 2019, dividends were growing. In fact, dividend growth is a sign of a possible high-quality company. But over the last 5 years, dividends have been absolutely flat. No growth in dividends whatsoever. Dividend yield of 4.4%. But if the dividends aren't going anywhere, share price isn't going anywhere, you're not seeing much growth at all in the company or your returns over time. So just looking at the last 5 years for Iress, based off financial performance and dividends, nothing much going for this company right now. And again, as I've mentioned a few times in this video already, that's why they've had a change in management and a new CEO came on board in 2022. Now to valuation, and this is where it does become interesting, not interesting in a good way. And I would have thought maybe some of these valuation metrics would have been sort of attractive. So people like me or investors like me who are unsure about this company and the quality of this company might be attracted to some good value. But PE ratio 37.2 sort of fits in with that EV to EBIT, which was quite high. Price to sales ratio 3.2, even price to free cash flow 21.9. I'm looking for numbers less than 10 when it comes to price to free cash flow for companies like this. Also did a reverse DCF on the earnings per share. What will the earnings per share have to grow to justify the current valuation of this company? And I've got a number of 21.3%. And based off the last 5 years, where this company hasn't grown at all, in fact, it's gone backwards, can I be confident that Iress can grow the earnings per share at 21.3% per year. And obviously, the market is, I wouldn't say confident, but the market does think that possibly that Marcus Price, the new CEO, can turn things around and this company will become a growth story yet again on the ASX. I'm not so sure about that, but that's what the market's thinking right now. One thing I look at when I am researching a company and I'm looking at the valuation is I want to see what the valuation metrics of the company now compared to what they usually are. And that way I can say maybe this company, if they do have a high valuation metric, maybe this company is actually attractively valued based off the history. So right now, the price of free cash flow, this is straight from Guru Focus. So their price of free cash flow might be a little bit different than mine, but right now it's around about 22. And historically, and this is over the last 10 years, the price of free cash flow for Iress has been between about 17 and 36. So it is on the low side. And if it did get to say about 35, and it briefly got to 35 in 2021, that could be suggesting that the valuation of this company is on the high side. So this is probably one scenario, one argument where you might be successful in saying that Iress is maybe good value at current valuations. Now onto the charts. Got to be looking at the daily chart first, and then we'll look at the monthly chart over the past 20 years for this company. And as soon as I look at the daily chart, if you just look at this whole period, you go with nothing exciting here. This is probably what I would have expected for a company that is really going nowhere when it comes to their financial performance. Share price has actually decreased over the past year, but there's no trend. But you could argue when you look at the whole 1 year period that the trend is down. But if you look at the last, say, 2 or 3 months, since definitely the low point in the middle of March, we have seen a little bit of excitement in this company, and the share price has moved into a short-term uptrend. And the last time the share price was at these levels was actually way back, well, not way back, but in September of last year. Also, a bit of a double bottom here. So we saw the share price get to a low of about $8.40 in September and reach those lows again in March. And that level, that support level, is very important once we look at the wider or longer picture. So let's have a look at the monthly chart for this company. And you do get a little bit of a different picture when you do look at the monthly chart for this company. Now, if I saw this chart without any reference to what the company is, I'd say, well, for the majority of time that this company has been a listed entity on whatever exchange it is, it's been pretty good. The share price has been increasing. The share price has been in a monthly uptrend. So when this company listed on the ASX, it got as low as about $1.50 in 2003. And then between 2003 and just before the GFC, the share price went from $1.50 all the way to a high of $9.50. That was a time to be a shareholder in this company. But also from the bottom of the GFC, share price got as low as $3.50 all the way to its price high, share price high, or just before COVID-19, reached $14.50, almost $15. That was also a good time to be a shareholder of this company. The share price was in a pretty good uptrend. But from that high in 2019, we also saw the share price get back up to those highs in 2021. It hasn't been a good story for this company. In fact, I would even argue that this long-term uptrend in the share price of Iress has come to an end. Now, remember in the last slide, I mentioned that $8.40 was a very important support level for this company. So not only did we see that double bottom in September and March, so September last year and March this year, during the COVID-19 financial panic, the share price of Iress got down to about $8.40 as well. So again, this is a very strong support level for that company. And if the share price fell below $8.40, that will be a bearish move. The next 5 companies I plan on doing in this series are Clover Corporation. I've already done that video. Well, not record the video, but very close to recording that video. And then we'll have a look at AGL, Parenti, Lycopodium, and Mass Group. So all those companies have a similar theme, not identical theme. So I might need a little bit more diversification when it comes to Kneppy's analysis. So after Mass Group, I'll probably be looking at a different type of companies other than mining and mining services companies. And of course, if you do have a suggestion of a company you'd like me to feature in Kneppy's analysis, the only reason I'm doing AGL, even Lycopodium and Mass Group, is because they were suggestions that viewers of this channel recommended to me. And I went, yeah, why not do a Kneppy's analysis on those companies? So if you do have a suggestion, just leave that in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.